In this part, I'm introducing another important operating activity, income taxes, which is a significant expense payable to the government. Since it is also an expense, it's very important to understand what's a component of the income tax, how to calculate the effective tax rate, and reconcile the income tax at the statutory rate with the provision for the income tax. We talk about the income tax in chapter 2 regarding the deferred tax assets and deferred tax liabilities to understand the firm's activities. And this is a tax disclosure for the past 3 years. The first session is income before tax, which is one item available in the income statement. It shows us more details: the domestic income before tax and international income before tax. Firms operate in different jurisdictions are subject to different tax laws. So earnings we reported here separately. The next one is the component of the provision for the income tax. This section is a tax payable to the government. This is tax expense. In the 2012, this firm paid 2004. The income tax expense, the difference 86, which is also available here, is the total deferrals. This also implies the firm's deferred tax liability increase because it defers its tax payment. This table shows us the source of income before tax, the component of provision for income taxes. So next, we can use this table to calculate the effective tax rate. 2012, the firm's tax expense is 2,090. Income before tax is 8,304. So the tax rate is 25.2%. 2011, 2,372 divided by 8,834, so is 26.8%. 2010 is 1,894 divided by 8,232, so it's 23%. We know that's the overall effective tax rate. Because we are given the tax expense for different jurisdictions and also the income before income tax, so we can calculate domestic effective tax rate and international effective tax rate. I just use 2012 as example. So for the domestic, the federal tax payment is 911 plus 154 deferrals. State is 153 and deferral is 27. So that's total tax expense in 2012 in the United States, and divided by the income before tax earned in the United States is 3,234. We can get effective tax rate in the States is 38.5%. International, we use the foreign tax paid plus the deferrals, which is negative 95, divided by income before tax earned in other countries is 5,070. It's 16.7%. The overall effective tax rate is 25.2. Domestic is 38.5. International is 16.7%. So the United States was well known for its high corporate tax. So that's why large US firms, they have foreign subsidiaries. And from this we learn this firm actually pay more tax in the States than in the foreign countries. The next disclosure required for each firm is the reconciliation of the income taxes at statutory rate with income tax expense. We know before 2018, the US federal tax rate is 35. That's the tax rate for the highest bracket. And this is the effective tax rate. The item in the middle represents the reconciliation. In 2012, why this firm pay only 25 but not 35? Because its foreign subsidiaries reduced its tax rate by 7%. State income tax increased the overall tax rate. Another factor decrease effective tax rate is tax benefits related to the tax court decision. This item is not persistent. Acquisition could also bring firms tax benefits, for example in 2010, and any other items which are minor. So the items in the middle actually explained why the effective tax rate is different from the federal tax rate. If a firm does not have the operation or subsidiaries overseas or tax sheltering activities, they will not have this item. Tax rate is the same. The effective tax rate are different, which can be accounted for by all the items in the middle. From this disclosure, we learned whether any items is persistent or not. So it is very useful for us to predict the future tax rate to determine the future tax expense.